Let me paint you a picture. Two people start investing at the same age, same income, same financial goals. One of them hires a financial advisor, pays a management fee, gets a carefully curated portfolio, and receives quarterly reports with impressive-looking charts. The other one opens a free account online, sets up a $50 automatic transfer every month, and never thinks about it again. 25 years later, the person who did almost nothing has more money, significantly more. And the person paying for professional guidance is trying to figure out where it all went wrong. Hi, I'm Ryan, and what I just described isn't a hypothetical. It's the actual documented outcome that plays out across millions of accounts every single year. And once you understand why, you will never think about investing the same way again. Here's the uncomfortable truth about the financial advice industry. It is not designed to make you wealthy. It is designed to make money from you while you attempt to become wealthy. Those two things sound similar. They are not. The average actively managed mutual fund, the kind most financial advisors put your money into, charges somewhere between 0.5% and 1.5% in annual fees. That might sound like nothing. After all, 1% is basically a rounding error, right? Let's run the numbers and see if that's still how you feel.
Say you invest $50,000 at age 30 and leave it alone until you're 65. At a 7% annual return with no fees, that $50,000 grows to roughly $530,000. Now apply a 1% annual management fee. That same investment, same return, same 35 years, ends at around $380,000. You just paid $150,000 for the privilege of having someone else manage your money. And here's the part that should genuinely make you angry. Most of those actively managed funds don't even beat the market. Research from S&P Global shows that over any 15-year period, more than 90% of actively managed funds underperform a simple index fund. You paid more, you got less, consistently. So what is this $50 investment that quietly beats the professionals? It's a total market index fund. And the reason it wins isn't complicated. It's almost embarrassingly simple. An index fund doesn't try to beat the market. It just owns the market. When you buy a total market index fund, you own a tiny piece of every publicly traded company in the United States. Apple, Amazon, a regional bank in Ohio you've never heard of. All of it. When the market goes up, you go up. When it goes down, you go down. No manager is making decisions. No analyst is picking winners. No one is getting paid to guess what happens next quarter. And that's exactly why it wins.
The enemy of investment returns isn't market volatility. It isn't economic uncertainty. It isn't even bad luck. The enemy of investment returns is cost. Every dollar that leaves your account in fees is a dollar that never compounds. Every basis point you pay to a manager is a basis point that doesn't grow. Index funds from providers like Vanguard and Fidelity charge as little as 0.03% annually. That's not a typo. 0.03%. Compare that to the 1% average for actively managed funds, and you're talking about a difference that compounds into hundreds of thousands of dollars over a lifetime. But here's where the $50 number matters more than you think. Most people believe that meaningful investing requires meaningful money, that you need $10,000 or $50,000 or some serious lump sum before investing is worth doing. This belief keeps millions of people on the sidelines for years, sometimes decades, while they wait to feel ready. And waiting is the single most expensive mistake in personal finance. If you invest $50 a month starting at age 22 into a total market index fund, earning the historical average return of roughly 10% annually, you will have approximately $380,000 by age 65. From $50 a month. From less than the cost of 2 decent dinners. The money you put in over that entire period? Around $26,000. The rest, over $350,000, was created entirely by compound interest.
By your money, silently, automatically, while you were doing literally anything else. Now, let's talk about what happens when you start later, because this is where people make the second big mistake. If you wait until 32 to start that same $50 monthly investment, you end up with around $150,000 by age 65. Same amount invested each month, same market returns, 10 years later start. But the outcome is less than half. You didn't lose half your money, you lost half your time. And time is the one thing in investing that cannot be bought back at any price. This is why financial advisors rarely talk about index funds. Not because they don't work, but because they work too simply. There's no complexity to justify a fee. There's no active management to charge for. There's no reason to need a professional intermediary at all. The entire model of paid financial advice depends on investing feeling complicated enough that you believe you need help. Index funds remove that dependency entirely.
Now, before you think this is just about being cheap or cutting corners, let me be clear about something. There are legitimate reasons to work with a financial professional. Estate planning, tax strategy, major life transitions, these are areas where good advice genuinely pays for itself. What doesn't pay for itself is paying someone 1% a year to put your money in actively managed funds that statistically underperform the index you could have bought yourself for nearly free. The strategy here isn't complicated. Open a Roth IRA if you're eligible. If your employer offers a 401k with a match, contribute at least enough to get the full match first. That's an instant 50 to 100% return on your money that no index fund can compete with. Then, direct additional contributions into a low-cost total market index fund. Set it to automatic, increase the contribution by even $10 every time you get a raise. And then, the hardest part, do nothing. Don't check it every week. Don't panic when the market drops. Don't try to time anything. The research on investor behavior shows something fascinating and depressing. The average investor earns significantly less than the average fund, even index funds, because they buy high when they feel confident and sell low when they feel scared. The fund performs fine. The human managing the fund destroys the return. The best investment behavior is almost no behavior at all. This is why automation matters so much. When you automate a $50 monthly investment into an index fund, you remove yourself from the equation. You buy in up markets and down markets without making a single emotional decision. You benefit from dollar cost averaging without even trying, and you compound returns over decades without ever having to be smarter than the market. The $50 investment that beats most financial advisors isn't a secret strategy. It isn't a hidden loophole. It's just math, patience, and the discipline to start before you feel ready. Because the market doesn't care whether you feel ready. It just keeps compounding, with you or without you.